Hello, thank you so much for being here. I'm Chenyin, and I'm here today to talk to you about value investing, especially the performance comparison between value investors and the market index. I'm going to be spending the next 30 minutes talking about how value investors beat the market. And at the end of my presentation, I would like to share some of my personal views about it. So, to start with, what is value investing? Value investing is an investing style developed by Ben Graham in 1930s. Its main idea is to find a stock or security that is trading under its intrinsic value. There are mainly three steps in the value investing. Let's talk about it one by one. So the first step is to identify the undervalued stock, which is also called the screening process. Investors usually develop a rough list of stocks that meet their basic screening criteria. So for value investors, stocks who have low PB/P or high dividend yield seems to maybe these stocks may be a value stock. So for value investors, they usually choose these stocks have those characteristics among hundreds of thousands of stocks. So they develop their own list of stock. There is actually another investing strategy, growth investing, that could be very easily mixed up with value investing, because they both think that the price of the today is too low and will be higher. So what is the difference between the value investing and the growth investing? Actually, value investors buy stocks that are on sale, while growth investors, on the other hand, look for stocks that grow substantially than others. They don't care what the intrinsic value of the stock is. As long as the stock price and the company's growth are linked, the growth in the earnings of the revenue will be directly translated into an increase in the stock price. So, growth companies are typically younger companies that outperform the industry, but they are trading at a premium to the industry valuation. So for growth companies, they usually have high PE or high BB, and they tend not to pay dividend because they would rather invest that money into their own internal growth. So basically, for value investors, they buy low and want to sell high. But for growth investors, they want to buy high and sell even higher. I think that is the major difference between these two investing strategies. But also Buffett says the best. He said that growth and value investing is actually joined at the hip. Growth is actually a kind of component in calculation value. So, for instance, if I invest in a cheap and fast-growing stocks, am I a value investor or a growth investor? It's very hard to distinguish these two. Alright, let's move to step 2, estimate the intrinsic value. I think this is the most important and core part in value investing. After we develop a list of stocks, we have to identify which of these stocks are truly undervalued. Because a stock may have a low PE or PB ratio just because it is actually beginning to lose value, or it is just not worth that much. So how could we kick out those bad guys? There are generally 4 methods to estimate the intrinsic value. The first is what we know the net present value, which is to calculate the discounted value of the anticipated future cash flows. For value investors, these cash flows actually equals to the free cash flows. Typically, it equals to the revenue minus the capital expenditures. So after that, these money are available to the shareholders, and if we could anticipate this cash flow stream and discounted it at a reasonable discount rate, we could say that the value of the company actually equals to the net present value. But the difficulties are also very obvious. First, it's very difficult to estimate the cash flow stream. It involves a lot of uncertainties, such as the revenue, the depreciation rate, the tax rate, the expenditures, and Also, it's hard to find a reasonable discount rate. It depends on people's preference for the risk, and it also varies. That varies in the underlying business. So this method is a good one, but very, very hard to implement. Okay. The second method is the private market value. The underlying idea is to value a stock based on the valuation that other sophisticated, prudent business people have recently paid to similar business. Private market value can provide a very useful guide for value investors, but because say if you want to buy a stock but you have no idea what it was of, you could ask for industry specialist. Ask him how much would you pay if you want to take it private. That would definitely give you a good hint when you're valuing a company. Nevertheless, it has its own shortcomings, such as companies are not exactly the same, the conditions may change over the time, and however, this strategy worked well for Mr. Mario Gabelli, as his firm was getting off the ground in the early 1980s, and at that time it was also the peaking of the leverage buyout phenomenon. So he just grabbed this opportunity and earned a lot of money. So this method is actually proved to be a successful one, and we can consider it when we want to value a company. The third method analyzes the liquidation value. Liquidation value is the total worth of a company's tangible assets net of liabilities when it goes out of business. Since the liquidation is usually compelled by law, those assets are usually sold at lower price than fair value, while liabilities don't change. So when a stock price is lower than its liquidation value, it is a really attractive bargain. For value investors, the liquidation value typically equals to the net value, which excludes fixed asset value. This would mean that the buyers would pay nothing at all for the fixed assets, buildings, machineries, etc., or any goodwill items that might exist. The last method is stock market value. So this is actually a short-term valuation method. If you are valuing a company, you could consider the market value of the companies of comparable business. The price may not truly indicate the intrinsic value. It does provide as a yardstick of the company in the short run. Anyway, the key in intrinsic value estimation is to keep conservative. When we use all of these methods to compute the intrinsic value, we should usually adopt the lower one. Alright, okay, after the value investors get an estimation of the stock, they will compare it to the stock market price. If it's lower enough than the market price, they will buy it. I will remark this topic later in the presentation. So after all these preparations, value investors can wait and sell the stock when its intrinsic value is realized or almost realized. There is one very important prerequisite condition for value investors to gain, that is, intrinsic value will be realized. What if the intrinsic value never surfaces? What if the market price really reflects the intrinsic value? The efficient market hypothesis is that the price of the stock reflects all the information available about it. In other words, anything anyone can find out is already priced in. That basically means that you cannot beat the market. The efficient market hypothesis takes three forms. The weak form maintains that past stock prices provide no useful information on the future direction of the stock price. In other words, technical analysis cannot help investors. The semi-strong form says that no published information will help investors to select undervalued securities, because the market has already discounted all publicly available information into security prices. The strongest form maintains that there is no information. whether it is public or private, that would benefit investors. The implication of both semi-strong and strong form is that fundamental analysis is useless. So, if the efficient market hypothesis is really true, it's meaningless for value investors to find undervalued stock because it doesn't exist. Efficient market hypothesis also states that changes in the price are expected to be random and unpredictable because new information by its very nature is unpredictable. Therefore, stock prices are said to follow a random walk. So, efficient stock markets, when prices are always accurately reflect the intrinsic value, the only risk that matters is the random fluctuation of price. Based on this belief, modern portfolio theory was developed by Harry Markowitz. It further assumes that the stock prices follow a Gaussian distribution, so that the risk of a stock is the variance of its historical price. It states that you can minimize your exposure to this risk by holding a diversified portfolio. All that you're left with is market risk. To construct this diversified portfolio, Mr. Markowitz introduces the efficient frontier. For every level of return, there is one portfolio that offers the lowest possible risk, and for every level of risk, there is a portfolio that offers the highest return. These combinations can be plotted on a graph, and the resulting line is the efficient frontier. Any portfolio that lies on the upper part of the efficient frontier is called efficient. So, even if we had risk-free asset, combined a stock portfolio that sits on the efficient frontier, we can actually increase the returns beyond the efficient frontier. The new efficient frontier is called capital market line. So, modern portfolio theory says that it is actually a waste of time to study individual investment opportunities because you can never beat the market. The best way is to form the market portfolio. Indexing is an investing strategy which believes market-efficient hypotheses. It attempts to construct the portfolio as closely as possible to replicate the market index, such as S&P 500. Index fund managers don't buy at a particular price. They don't care the fundamental part of the company as long as it is in the market index, because they believe that market is efficient and struggling. Trying to outperform the market is in vain. However, for value investors, this is definitely not the truth. Through value investing strategy, investors can beat the market not because of luck, but because the market is not that efficient to price every stock correctly on its intrinsic value. A famous quote of Warren Buffett is, "In the short run, the market is a voting machine, and in the long run, a weighing machine." The price of a stock is more determined by the supply and demand in the short run, such as money managers' short-term frequent trading activities, the group thinkings, and speculations. From my perspective, I'm more inclined to value investing. Say, if you hold a S&P 500 index fund, you are invested more in Google just because it is more expensive than any other stock. Also, when stock A in S&P 500 is excluded and is replaced by another stock, so index investors are to sell stock A massively just because it is not in the market index anymore. The price of stock A gets down, not because of any bad information, its fundamental business of it doesn't change at all, but because it is